When new investors enter into the market, the question I often hear is, which are the safe companies where I can invest my money? Because I'm new to this world of investing and the previous financial tools, all they've used is FDs or even just their regular savings account. They want some stability in their investments. But as you may know, stock market comes with its own risks. There may be ups and downs, but that is a totally understandable part of the journey. But you still want some safety in those stocks that you're buying, then this video is for you. In fact, this video is also for people who have burned their hands while investing in high risk companies and are looking for few reasonable companies to invest in at good valuations. So yes, in this video we'll look at few nifty 50 companies which are available at comparatively cheaper valuations, especially when you're looking at their long-term price to earnings graph, which is a measurement looked at to compare their valuations. They're still at the valuations at or near their 2020 crash levels. Welcome to another video. This is Ajay Ajith. Let's get started. So as I said earlier, if you're looking for relatively safe companies to invest in, what will you have to look at? Anyway, you'll have to do the fundamental analysis, the technical analysis and all of that. But there are certain large companies in the country which have stood the test of time and are still standing as the biggest companies in India. Yes, these stocks are known as the Nifty 50 companies in India, and those are what we are going to talk about today. And if you're a pure investor, I would suggest just go and invest in an asset like a mutual fund or a Nifty Bs, which will give you this relative safety for the long term as well. But if you're just starting your stock picking journey and you want to find these companies, you want to invest in stocks rather than Nifty Bs or mutual funds, then you can continue with this video. So yes, going into the screener tool here, it's not a paid promotion once again, but really because it is a good tool to do your basic fundamental analysis studies. So the first thing that we are looking at here is the company should have a market capitalization of greater than 1 lakh crores. A unicorn in the country is known as a startup which is having a valuation of greater than $1 billion. That is nearly 8,000 crore rupees. So here we are looking at companies which are at least 12 times the size of that. So that is a basic checklist we are giving here. And the next thing or the next factor that we are giving here is price to earning less than historical price to earning of 5 years. So the company's valuation currently should be less than the 5-year average valuation of the company. That is what we are looking for here. And let us run this query. So you're finding a lot of companies here, right? BPCL, IOCL, Bank of Baroda, State Bank, Axis Bank, and a lot of companies. Nearly 29 results have popped up here. So let's go through not every one of these stocks, but few stocks that I found interesting. And the first one will be Hindustan Unilever. So Hindustan Unilever, as you can see here, is a company with a 5 lakh crore market cap, and it has created a net profit. It has generated real profit of 10,300 crores over the last 12 months. It is an FMCG company, a fast mover consumer goods company, and you can see here, if you click on the read more, you can see here which are their major sources of revenue. So beauty and personal care segment is contributing nearly 42% of their revenue, and you can see the brands here as well: Dove, Lifebuoy, Lux, Pepsodent and Close Up. So a lot of popular brands coming under this company, and you can see that they have products under the home care segment also, which contributes 29% of their revenue. Vim, Domex, Sunlight, you can see Comfort, Wheel, Rin, all of similar brands here, but then providing a big chunk of their revenue, right? And you can see here there is food and refreshment as well. But what we are interested, and what I would say will not lie to you, is the financial performance of the company and its price to earnings ratio. So quickly looking at the price to earnings ratio, this is where the company stood at around the March COVID crash in 2020, right? So we are seeing here the price to earnings was somewhere around 63, and right now the company's price to earning is standing at 52. And the blue bar that you see below is the earnings per share of the company. That means for every share of the company that exists, how much rupees of profit is the company making. And generally, if you're talking about the price to earnings, the PE ratio, we are always looking at the price divided by earnings per share, not exactly earnings. So make sure you have that in mind. So you can see that it is relatively undervalued when you're comparing to all of the previous years. But when you're looking at the financial performance over the last multiple quarters, you can see it is having some trouble. From September 2022, it is having nearly a revenue of 15,100 crores. It has not been able to generate more revenue here. In fact, the earnings per share after peaking in September 2022 from 11.34 has actually reduced to 10.68. So the company is not able to grow. This can be because a lot of brands are coming into the FMCG space. If you're watching Shark Tank India, you can see that majority of the companies which are coming are under the skincare, under the food, under the home care segments, right? So a lot of competition is increasing, and these other competitor companies, they're mostly focusing on the premium customers, the ones who are not generally looking for value but are able to pay a lot of money for that product. So as an FMCG brand, Hindustan Unilever is not able to grow. That is why I'm not too bullish on the stock. The similar analysis can go for Nestle as well. It was the second stock in my list, and Nestle also is displaying a similar behavior where it is not able to grow beyond a certain point, not because there is no market available, but because the competition from this new age players has become too tough. Yes, so available at a good valuation, but it is not giving me the conviction of growth or really good growth over the long term, and that is why you can also avoid the stock. So the next company that we are looking at here is Eicher Motors Limited. You might all know it as a parent company of Royal Enfield. Yes, so you can see in the bottom right here, it is an iconic brand, the owner of Royal Enfield, which is focusing on mid-size motorcycles between 250 to 750 cc. And the major factor that I like about this company is that it is sold in nearly 60 plus countries worldwide. And let's go ahead into the price to earnings ratio of the company. So this was the COVID valuations, or just before the COVID valuations, what was happening in the company, right? So the PE ratio was around 28. During COVID, it dipped to 20 regions, and right now it is back to 26. That means even though the stock price has appreciated, below you can see the earnings per share charts, right? The graph. So again, the PE ratio is what? It is price divided by earnings. So the earnings per share is moving up in such a beautiful fashion that the PE ratio is going down similarly. So that means even though you might see the stock price has gained a lot over the last few years, it is justified by the increase in earnings of the company. When you're looking at the profit and loss statements for the last multiple years, you can see it's showing a really beautiful growth from around 6,800 crores in 2013 and ending 2023 at 14,400 crores. And this company is generally enjoying the shift that Indian consumers as well as international consumers are showing, where the tendency to spend on high value items after the lockdowns in 2020 are increasing. So because they are a premium product, they do not have any 1 lakh or 80,000 rupees scooters or small bikes or anything, right? So because they are generally a premium company, they're enjoying the greater sales, right? So if you're looking at March 2020, they had an earnings of 9,000 crores that is reaching nearly 16,000 crores now, and similarly their profits have also increased. So Eicher Motors, yes, a thumbs up from me. A similar story has played out in Mahindra and Mahindra also. The price graph, if you're looking at it, has kept on going up from nearly 600, 500 in 2020. The company's share price is now trading at around 1,800. But if you're looking at the PE ratio, it suddenly tells a different story. So while the PE ratio was just around 28 before the COVID lockdowns, you can see that currently it is trading at a PE ratio of 20, and the earnings per share of the company is keeping on increasing. And you know that they're majorly dealing in SUVs. The sales of SUVs in the country are increasing. They're coming out with the Thar 5-door as well, which could push sales up even further from here. They also have electric vehicles in their lineup, and they're also a contender in Formula E, which is a motorsport championship globally for electric cars. So whatever learnings that they're having in that championship, they'll surely be incorporating that into their road cars in India as well. The only problem that the company is having is not having enough manufacturing capacity, but they're trying to solve it by introducing new manufacturing plants. So hopefully over the next few years, the company will see a lot of revenue and profit growth. So again, a thumbs up from me. The next two companies here are from the financial segment. So the first one is Kotak Mahindra Bank. When you're looking at their information here on the website, you can see that majority of their loans are in the home loan and loan against property category. They have a lot of exposure to corporate banking as well, which is good for the company. And if you're looking at the price to book graph, which is generally what we tend to look at in the case of banks or financial institutions, it is also at a lower level than the lockdown levels. So that is good for the company. So you can see here that in the company's profit and loss segment, they are able to grow their revenue in a really beautiful way. They have also grown their profit and loss in a really good way as well. So Kotak's 811 platform has created a lot of accounts over the last 10 years. Their focus on digital banking has also been great, and you can see that their earlier bets have been paying off really well over the last few years. And one more thing that I generally observed and liked about the bank is that they're not too aggressive. While their competitors are far too aggressive, giving loans out to everybody, these guys are only waiting for that one perfect customer who will take big loans from them, and without much risk they can give that loan to him. So generally safer loan book, you can see that the net NPA is only around 0.6%. So out of the total loans that they're giving out, the non-performing assets or the bad loans you can see are only coming out to nearly 0.6%. That is really good for any financial institution. So I feel it is one of the safer bets that you can have in the banking industry, just like the next one, which is HDFC Bank. So HDFC Bank has also had its fair share of problems recently. It was all over the headlines 2 months ago when the bank stock fell very heavily, and then now if you're looking at both the EV/EBITDA ratio or the price to book value, it is at a very cheap valuation, as you can see here. So I hope you get the trend. These stocks are not generally the ones which will go up in the next 1 or 2 months. These are generally safe bets that you can take, that at their current valuation, if you enter these stocks, there is a higher possibility that there is potentially lower downside. That means if the stock does fall, there is low chance of it falling by huge margin, and if it is moving up, it will move up in a very healthy, slow fashion. And the last company that I want to discuss here is Asian Paints. So they're having a market cap of 2.7 lakh crores, virtually no debt in its books, very low debt to equity, and you can see here or read more about the brand, right? You can see that it has multiple brands under its portfolio, including a home electronics appliances company called as Sleek, right? And you can see the revenue breakup here. Mostly their revenue is coming from the decorative business, which is a home painting solutions that they offer. And if you're looking at the PE ratio of the company over the last multiple years, you can see that even though it is slightly overvalued at a PE of around 50, the industry PE is also very high. And if you're looking at the valuation over the last 10 years, you can see that it is at generally a good level. And if you're looking at the company's growth over the multiple quarters and years, you can see that this present year is slightly a bit tough for the company, but then you can see that it is still making a generally healthy profit of 5,500 crores, much greater than the last financial year. So even though the last 12 months have not generally been great in terms of sales, the company is earning a really good profit on the same, and it has a long-term really good potential. So Asian Paints also gets my thumbs up. So yes, these are generally some Nifty 50 companies which are available at that lockdown valuations. I'm not saying go ahead blindly put all of your money into these companies, because the stocks need momentum as well. They'll start to move only when there is a good trigger. So even though it is consolidating now, does not mean over the next 1 or 2 months it will start giving a breakout. And also remember not to put all your capital into one stock at the same time. Remember to diversify properly, and even if you're investing into a certain stock, invest in different chunks. That means, so even if you were willing to invest 1 lakh rupees into the stock, invest it in tranches, 25,000 into 4. You can think about investing it that way as well. So let me know what you thought about this video, and if you want to see more videos like this. This is Ajay Ajith signing off. See you again. Bye bye.